ladies and gentlemen. I am Prahladan Iyer. I am Chief General Manager with the Export-Import Bank of India. I head the Research and Analysis Group of Exim Bank. It's my privilege to welcome all of you to this Masterclass on Impact of Union Budget 2022-23 on select sectors. It is indeed very encouraging to see the number of participants joining us for today's webinar. I just want to present a few logistics before we begin. At this time, all participants are only in listen mode. Today's webinar will have a presentation on the topic of impact of union budget on select sectors. If you have any questions or comments that you would like to share, feel free to send them to us through the question and answers tab on your screen. We will respond to the comments or questions after the entire presentation. We will also share a copy of today's presentation with all the participants after the webinar is over. Ladies and gentlemen, as part of its mandate to promote international trade from India, Exim Bank undertakes research on various industry sectors and also countries, as also on various macroeconomic issues of relevance to international trade and economy. In an effort to upscale the reach of our research activities and to create a platform for discussion on topical issues pertaining to India as well as the global economy, we launched this initiative of conducting online masterclass in 2009. We started in 2019, well before this became a new normal. The masterclass platform has helped disseminate information and knowledge dissemination on relevant issues. Exim Bank considers organizing such webinars as part of its wider mandate of promoting and facilitating the growth of India's foreign trade. After several successful webinars over the past 3 years, covering a wide array of topics related to exports, economy, and trade, we are happy to welcome you to today's masterclass on the topic of impact of union budget on select sectors. Ladies and gentlemen, this year's budget centered around the three main goals of Amrit Kal, or India at 100, including focus on growth and all-inclusive welfare, promoting technology-enabled development, energy transition and climate action, and virtuous cycle starting from private investment, crowded in by public capital investment. The budget also reiterates the importance of a counter-cyclical fiscal policy to boost growth during periods of uncertainty, with a significant emphasis on crowding in higher capital expenditure from both public and private sectors. Digital transformation has particularly been a major theme of this year's budget, with several tech-oriented announcements in an array of important sectors like agriculture, banking, education, and payments and monetary systems. Besides, the budget also focuses on climate-related actions, clean energy transition, design-led manufacturing, circular economy, and reducing carbon intensity is also a step in the right direction for achieving inclusive and sustainable technology-led development. Ladies and gentlemen, today's webinar is an attempt to analyze the various aspects of India's union budget and should hopefully provide key insights on the topic to industry, policy practitioners, research organizations, and professionals, among others. The webinar shall broadly cover key deficit indicators for the government, major measures announced in the union budget, and also the impact on select sectors. Let me introduce you to the speakers for today. Ms. Janvi Singh. She is an economist with India Exim Bank. She has extensive research experience in analysis of international trade, economic policies, agriculture, and industry dynamics. Her research work has helped to provide key policy recommendations to central state governments. She has also worked on institutional capacity building assignments for export finance in countries such as Rwanda and Ghana. She regularly contributes to discussions on contemporary economic topics through authored articles in media publications. Our second speaker today, Ms. Neha Raman, is also an economist with India Exim Bank. She has considerable experience in the areas of international trade and economic policy research. She has also extensively worked on preparing strategy papers for tapping export potential across sectors and markets, as also on providing policy inputs and industry insights to both internal and external stakeholders of the bank. She has helped in the preparation of state-level export strategy papers for several state governments and has also authored several articles on contemporary issues in media publications. Ladies and gentlemen, we sincerely hope that this webinar platform will provide perspective on this topic to all the participants. We look forward to your questions as also your feedback for today's session. Thank you. I now invite my colleague Janvi to kindly begin the session. Thank you.
Thank you, sir. Good afternoon, everyone. I'll just share my screen. Yes. Good afternoon, everyone. Once again, welcome to this webinar. Yesterday, the budget was announced. It was a growth-oriented, investment-focused budget. And like the past 2-3 years, we are here again, I and Neha, to take you through the impact of the budget on select sectors of the economy. This is a brief structure of my presentation today. First, we will begin with a brief background about the state of the economy in which the budget was announced. We will build upon this narrative as we move forward in today's session and discuss the impact of the budget. We will then be discussing some of the highlights of the budget, the key themes, the deficit indicators, the fiscal deficit estimates. All these things we'll be discussing after that. And finally, we'll be discussing the impact on exports and a sector-wise impact of the budget. So let us first begin with a brief scenario of the Indian economy. The growth forecast last week, we are aware IMF had released the growth forecast and it slashed the growth forecast for India from 9.5% that it had earlier estimated to 9% or to 9% in the latest estimate. The first advanced estimates also indicate a 9.2% growth in FY22. Now, at the face of it, it looks like a really significant growth, 9%. But we must keep this into perspective that this comes after a 7.3% contraction in GDP in the previous financial year. So although a 9.2% growth is substantial, but after a 7.3% decline in FY21, it may not be that strong a growth. In fact, if we see in real terms, the 2022 GDP will be barely 1.3% higher than what it was in FY20. So definitely this growth number, although it seems high, the recovery has not been that strong. If you look at industrial production, it had recovered after the second wave, and from September 2021 there were growth shoots, but since November 2021 again the industrial output is stuttering. The IIP growth was only 1.4%, and even the early data for December indicates that industrial output has not really recovered. In fact, in November the industrial output the IIP index dropped below the corresponding pre-COVID level. So this begs the question, what is stopping growth? Private consumption is one of the largest segments of India's GDP. Around 60% of India's GDP is constituted by private consumption, but its share has continued to dip. It was 60.5%, the share of private consumption in FY20, and it has reduced to 57.5% in FY22. Clearly, this indicates that there is a sustained slowdown in household consumption. It has clearly not recovered from the COVID-19 crisis. A major reason is that the unemployment levels remain elevated. Unemployment rate as estimated by CMI has been above 7% in October, November, December 2021. In fact, in December 2021, it was close to the 8% mark. So clearly, unemployment levels are quite high. If we compare these unemployment rates with what they were during the peak period of COVID, of course, it's an improvement because that time the unemployment rates had shot up to somewhere around 20%. So of course, there's an improvement compared to that period. But still, if we compare the unemployment rate to what it was, say, in 2017-18 or 2018-19, it is much higher. Also, this sets the need for a push. This sets a need for a push either on the fiscal policy front or the monetary policy front. Clearly, consumption investment revival has not happened to the extent we would expect, and monetary policy and fiscal policy need to come together and provide a boost to the economy. But here comes the constraints which we are facing on the monetary policy front. As we are aware, the global developments might halt the continuation of the accommodative monetary policy stance of the RBI. US Fed has indicated that there might be interest rate hike as part of its broader tightening of its historically easy monetary policy. In fact, for 2022, the median forecast suggests that there will be 3 rate hikes by the US Fed. Alongside, inflation is also re-emerging as a threat in India. Retail prices had surged to a 5-month high of 5.6% in December 2021. Now, this is well below the tolerance level of the MPC, but still there is a looming threat of the inflation exceeding the 6% mark. Rising inflation combined with an aggressive rate hike by the Fed may force the RBI to quicken its rate hike cycle so that it can maintain an interest rate differential and keep foreign portfolio money invested in India. Clearly, monetary policy might have to be reined in. Also, monetary policy transmission has also not been to the extent as it was expected. The economic survey, which was released a day before the budget, indicates that the pass-through through the interest rate channel has especially not been strong in case of private sector banks, and this is in spite of the several initiatives which have been taken to increase the interest rate pass-through. In spite of that, the interest rate channel has not been that successful in monetary policy transmission to the full extent. So clearly in this background, a major boost in fiscal policy was needed to revive consumption, to revive investment, and that is exactly what the government has delivered in this budget. It's a growth-oriented budget which caters to the need for consumption and investment revival. Also, it is not a budget which is looking at the short-term measures. Many of the announcements and reforms are aimed at gradually preparing the economy for greater value addition, efficiency, and competitiveness. In fact, the Honorable Finance Minister has clearly highlighted that the budget is aimed at preparing the economy for the Amrit Kal, that is the period leading up to the India at 100. So it is setting the course for the next 25 years, this budget. Now, the Honorable FM has, in her speech, highlighted 4 priority areas. First is PM Gati Shakti, which will focus on infrastructure and logistics. My colleague Neha, she will discuss aspects related to Gati Shakti in greater detail in her part of the presentation. The second priority area is inclusive development, and we have seen several initiatives for farmers, for MSMEs, for inclusive finance. We'll be discussing some of these initiatives as we go ahead in our presentation. The third priority area, it is a sort of longish one: productivity enhancement and investment, sunrise opportunities, energy transition, and climate action. This very long category basically highlights the government's commitment to green energy, sustainable infrastructure, manufacturing growth, and technology intensive growth. Also, the fourth priority area is financing of investments, where the Honorable FM talked about green bonds, increasing capital investments, and related subjects. Looking at the budget in numbers, the fiscal deficit in 2022-23 is estimated at 6.4% of GDP. Although lower than the revised estimate of 6.9% of GDP in the current financial year, it is still a massive financial boost. The government has also reiterated its commitment to path for fiscal consolidation and noted that it will be reducing the fiscal deficit to 4.5% of the GDP by FY26. The finance minister also highlighted that the outlay for capital expenditure in the union budget has once again been stepped up and it has been stepped up sharply by 35.4%. This larger focus on capital expenditure has actually improved the quality of fiscal deficit. When I mean the quality of fiscal deficit, I mean to say that the revenue component has somehow declined, and the capital side has seen an increase, which will actually lead to more of an improvement in growth and output and employment. If you look at the share of the revenue deficit in the fiscal deficit, it has reduced from around 68.4% in FY22 as per the revised estimate to around 59.6% in the budgeted estimate for FY23. Accordingly, the revenue deficit as percentage of GDP is also expected to be around 3.8% of GDP. The rating agencies have been watchful of this deficit figures, and in fact, Moody's has noted that the budget lacked any tangible measure to increase revenue generation, even though the capital expenditure plans have gone up significantly. So that is why we see that the government borrowings have gone up, and it now accounts for 36% of the sources of funds, which is in fact very high. If we look at the expenditure side, interest payments have gone up and now account for 20% of the government's expenditure. And given the sizable expenditures that we are seeing compared to the pre-COVID levels, these interest burden are expected to increase in the future. But again, if the fiscal measures reap benefits and the economy grows at a remarkable pace, then these interest costs could remain in comfortable ranges. Now, let us look at the impact on some of the major sectors. Before we move to the individual sectors, I would first like to highlight the impact on exports. The budget has focused on infrastructure and logistics to a great extent. There have been several announcements in this space, and this is expected to bode well for exports from India. Currently, if you see the logistics cost, it is estimated at 14% of the GDP for India, while the global average is somewhere around 8%. This impacts the competitiveness of exports from the country. Clearly, the infrastructure push, which we have seen in this budget, will help bring down these logistics costs and thereby improve the price competitiveness of products. The Honorable FM has also talked about the one station, one product concept. Station here meaning the railway stations. This is a natural extension of the ODOP initiative of the government. Adding this logistics aspect and creating synergies between the ODOP and one station and one product can definitely lead to development of clusters at district level, achievement of economies of scale. These will improve competitiveness and thereby increase exports from India. Several custom duty changes have also been announced in the budget. Now, custom duty changes are tricky because their effect is two sides. If custom duties are increased on some product, the domestic manufacturers of those products, of course, benefit. But if those products are inputs for some industry, then input prices increase for some industries and their margins reduce. So, custom duty changes should be in value-added areas where there is scope for increasing value-added production, and in low value-added areas, custom duties can actually be changed. So that is what we have seen in this budget as well. The custom duty changes focus on increasing production in high value-added areas, and we have seen a big boost in the capital goods sector where a lot of exemptions have been removed. We'll be coming to that later in today's presentation. Also, there has been focus on the phased manufacturing program, which bode very well for the electronic sector, and several new sectors have also been added in the ambit of phased manufacturing program, and we can see the technology intensive areas really growing due to these changes. Also, the budget mentions that railways will develop new products and efficient logistics for the small farmers and micro and small enterprises. Now, small farmers, small enterprises, they tend to focus on their domestic market. They don't tend to reach out to the international market. So having these kind of initiatives which help them link to the export market will help expand the exporters base in the country. When the exporters base expands, naturally exports will increase. Also, this will improve the income of farmers, of MSMEs, because export prices, getting the export market, that will improve the margins for exporters. It will help them fetch better prices, and clearly it will also fit in the entire vision of the government to double farmers' income and improve MSMEs. It will fit into those narratives as well. Another very important development that has been with regard to SEZ Act. Now, SEZs have contributed to India's export growth in software and IT services. They have aided foreign investment and helped exports in several categories. Companies which operate in these SEZs, they get tax stops, because of which they have been able to achieve price competitiveness. But the act itself is some 16 years old, and it definitely needed a revisit. Also, the fact that the center will partner with states in reviewing these laws and making them more flexible and business friendly is a much needed step. Also, several reforms in custom administration of SEZs have also been proposed. It is proposed that the customs will be more IT driven and function on the customs national portal. So this will lead to better trade facilitation, and the FM also announced that only risk-based checks will be undertaken. So this will again reduce the time and cost of trade from SEZs. So these are again very, very positive moves from the union budget. Next, as I was mentioning earlier, there have been more than 350 tariff exemptions which will be phased out. The government is also simplifying the concessional rates applicable on various products through notification by incorporating all these exemptions in the customs tariff schedule only. So this will help basically simplify the customs rate and tariff structure. And also removal of these exemptions will help local industry develop capacities, achieve economies of scale, and also export competitiveness. Now, another area is that of project imports and capital goods. Several exemptions on these products have been phased. I mean, several custom duty concessions will be phased out on project imports and capital goods. This will be a very important step, because it will promote production of capital goods and machinery domestically. Also, these products, capital goods, machinery, these help in project exports. So we have seen that even during periods when global merchandise was facing a slowdown, project exports showed remarkable resilience, because the demand for infrastructure, demand for machinery, these remained resilient even when the merchandise exports as such were witnessing slowdown. So if we build capacities in this area of project imports and capital goods, if we give space to the domestic industry to grow and achieve economies of scale, this will impart resilience to our exports basket. Also, there's a greater focus on technology intensive and sunrise sectors. This will again help Indian manufacturing and exporters move higher on the value chain. And as you move higher on the value chain, you face less competition from low-cost suppliers. And this will again add resilience to India's exports basket. The government has also announced Ease of Doing Business 2.0, which will further improve the cost and the time of doing business, and that will of course have an impact on exports as well. So this is a broad impact on exports per se. Overall, very, very positive. But of course, although the custom duty changes will be implemented immediately, but development of technology intensive sectors and all these will take some time. So there are short-term measures also, there are medium to long-term measures also when we look at the impact on exports. Coming to the agriculture and allied sector, many announcements were made in this sector. which underscored the government of India's commitment to double farmers' income and boost agri exports to $100 billion. These have been two visions of the government which have been time and again been said at various forums, and the recent budget and the measures which have been taken really will really push forward this agenda. The Kisan drone scheme, which has been announced in the budget, this will help improve operational efficiency and maximize profitability in the agriculture sector. So drones, the idea is that drones will be employed for crop assessment, land records, spraying of insecticides, etc. It's a very welcome move and will make India's agriculture sector future ready. Additionally, chemical-free natural farming will be promoted. Natural farming will be promoted. So the first phase will be on farmers' land in 5 kilometer wide corridors along the river Ganga. Now, natural farming is very, very important because if we are going to tap markets like Europe, USA, Japan, which are ultra quality conscious, we need to move our products more in line with the demand patterns there. And there, the advanced markets are moving towards more healthy, natural farming, organic farming, sustainable farming. So this program of chemical-free natural farming, which has been proposed in the budget, is going to make India's agriculture export ready for tapping these advanced markets. There's a lot of encouragement for agri-tech startups as well. A fund has been announced which will be facilitated through NABARD. It would finance startups for agriculture and rural enterprises relevant for the farm produce value chain. Again, this will improve technological intervention in the agri space and help the agriculture sector basically move out of the traditionally low investment, low growth cycle which we have been seeing since forever in the agriculture sector. The UN General Assembly had decided to celebrate 2023 as the International Year of Millets. The government has also announced its support to the millet sector as a part of its budget. India is in fact one of the largest producers of millets, with Rajasthan being the largest producing state. So a lot of support has been given to millets for post-harvest value addition, promoting consumption of millets. Also, more importantly, branding of millet products, both nationally and internationally. So this will help in international marketing of millet products. So clearly here also there is some element of focus on India's agri exports because the government has clearly indicated it also wants to focus on branding of millet products both nationally and internationally. Another important area is that of oil seeds. We are aware that the production and domestic availability of oil seeds falls way short of the need of domestic demand or the need for domestic market. So around, I think 60% of the edible oils consumed in the country is met through imports. So recognizing this, the government in the budget has announced a rationalized and comprehensive scheme to increase domestic production of oilseeds. PM Kisan. Now PM Kisan is a very, very important product, a very important scheme of the government, especially from the point of view of exports. Because as we go forward in the agri exports, as we try to achieve the $100 billion of target, will more and more come under the scrutiny of advanced nations, of WTO, and we need to make sure that our subsidies are WTO compatible. Now, PM Kisan is an income support program, which is considered non-trade distortionary. That is why it is being given in several developed countries also, and it is also allowed. Price support, unfortunately, is not allowed as per WTO because it is considered trade distortionary. The government had started this scheme as it decided to move away from the price support model to an income support model. But the budget allocation this year for PM Kisan has been almost same as what it was last year. And given that the amount which is given to farmers has remained the same since this PM Kisan initiative was announced, that is at rupees 6,000, the real value of benefits has actually dipped. So this is again one area where the agriculture sector did not get as much of a benefit as was expected. Shrimp aquaculture industry. Now, this industry is heavily dependent on imports of larval seas, artemia, and shrimp brood stocks, as there is hardly any domestic production. These are imported, these inputs are imported for growing shrimp larvae to supply to aquaculture farmers. Now, the import duty on brood stocks of shrimps was around 10%, and this duty has been removed, which makes it easier for the industry to import and increase its production. There's also some focus on skill development, as states have been encouraged to revise their syllabus of agriculture universities to focus more on things like organic farming, sustainable farming, value addition, and management. Again, there is a lot of technological push. A new scheme in PPP mode it has been announced for delivery of digital and high-tech services to farmers. This will again enhance the technological intervention in the agri sector. Irrigation has also received substantial focus in the budget. The Kane-Betwa link canal has been announced, which will be 221 km long and will also include a 2 km long tunnel. Now, this region where this is this has been announced is prone to water crisis. So this project will definitely boost irrigation in the region, improve productivity. Also, FM has also announced that draft DPRs of 5 river links have been finalized, and they will be supported based on the consensus among states. Also, a comprehensive package for fruits and vegetables with participation of state governments have been announced. And of course, here again, the focus is on participation of state governments, which clearly indicates that the center wants states also to have a greater role in development of both agriculture and industry. Coming to BFSI. A progressive announcement in the BFSI sector is that the IBC resolution process would be sped up, with the time taken to exit being reduced from 2 years to 6 months. Also, the emergency line of credit, the ECLGS, which was established mainly for the SME at the onset of COVID-19, there were expectations that it will be extended, it will be widened, and the government has delivered. It has been extended up to March 31st, 2023. Also, hospitality has now been included, and an amount of 50,000 crore, especially for hospitality, has been allocated. The government has also announced that it will bring all post office branches into the core banking system. Now, this could lay the roadmap for bringing postal deposits into the mainstream financial system. And again, it is a very big move, because it will allow easier, it will allow a wider suite of services which can be provided to post office depositors. So again, this has been a very positive step. The government has also discussed bringing up a sovereign green bond, which my colleague will be discussing later in today's presentation. Also, CGTMSE, which was started in 2000 by the MSME Ministry and SIDBI to catalyze the flow of institutional credit. There is an announcement of revamping that as well, with required infusion of funds, and it is expected that this will lead to facilitation of additional credit of nearly 2 lakh crore for the micro and small enterprises. Here also the focus is there on digital. Technology has been a focus area here as well. Government has proposed to set up 75 digital banking units in 75 districts across India through the scheduled commercial banks. There is also a proposal to introduce CBDC using blockchain and other technologies. Gift City has also been mentioned several times in the union budget. One of the most important steps that has been taken is to speed up dispute resolution, cross-border dispute resolution through International Arbitration Center, which will be set up in the GIFT City. Now, proposal to set up this International Arbitration Center is something similar to the Singapore International Arbitration Center. For the past 4 years, the GIFT City had an office of the Singapore International Arbitration Center, but it never really took off because it could only hear the matters, but it could not give any arbitration awards. So there was no regulatory support basically. So this proposed arbitration center will have the regulatory support, the necessary regulations, and this is again a very, very important move in the budget. Along with an arbitration center, the government also proposed setting up of world-class foreign universities in the GIFT City. The university will facilitate availability of trained manpower and will be free from domestic regulations. Government has also announced that the use of surety bonds, surety bonds can be used as substitute for bank guarantees in government procurements. This again is a very, very important announcement because as insurance companies begin offering these products, it will create competition for guarantee business of banking system. IRDI is to provide framework for issue of surety bonds by insurance companies, but it is of course a very positive move. But for banks, it will definitely create more competition for their bank guarantee business because it is directly competing with the kind of bank guarantee business which they do. The bank capitalization was one issue, one area of interest, but unfortunately there was no allocation for PSB recapitalization. It is true that banks are well capitalized and they actually do not require any fresh capital infusion as such. But we must be mindful that infusion of capital is also important and a cornerstone for future growth. So there's a feeling that government could have provided capital for some of the banks, and no allocation at all is somewhat disappointing. In chemical and allied sector, if we see, customs duty have been reduced on methanol and acetic acid, which would have a positive impact on downstream units. It will improve competitiveness. Custom duty on heavy feedstock for petroleum has also been reduced. Also, several measures have been announced for supporting the domestic industry. There's increase in basic custom duty for several chemicals such as crude glycerine for soap manufacturing and sodium cyanide. Many exemptions have also been rationalized so that domestic industry can be supported. The conventional basic custom duty on biodiesel has also been proposed at 10%. This is and the other initiatives have been also taken to encourage blending of biodiesel. Now, blending of biodiesel, if we see the current scenario in diesel, it is less than 0.1%, and the average ethanol blending percentage in petrol is nearly 8%, while the target which has been set for ethanol blending has been 20%. So to encourage the efforts of blending of fuel, unblended fuel shall attract an additional excise duty of ₹2 per litre from 1st October 2022. If we look at electronics, we see phase manufacturing program has been introduced for wrist wearable devices, hearable devices, and smart meters. In phase manufacturing program, basically you have graded custom duties. We have seen these programs in case of mobile phones, it would really well for the industry. India had no capacity for mobile phone. Telecom equipment was one area where we had massive trade deficit, and we saw the phase manufacturing program come in, and that is when we started seeing some increase in capacity building, and we started seeing some neutralization of trade deficit in mobile phones. Now, some other sectors have also been announced for this phased manufacturing program. Clearly, it is going to bode well for these segments and for electronic sector as a whole. Moreover, duty concession on parts of transformer of mobile phone chargers and camera lens of mobile camera module are also being provided by the government to further strengthen the manufacturing of mobile phones in the country. It may be noted that India has not only reduced its trade deficit in the telecom equipment segment, it has also substantial exports in these segments, and these duty concessions which have been announced are going to establish the country as a hub for production of these items even more. Again, our drone and strategic electronics have also received a major boost. Since several budgets, we have been seeing that defense, especially private participation in defense, has received a lot of focus, and this budget was no different. We saw the defense R&D space being opened up for industry, startups, and academia. And not only this, 25% of the defense R&D budget has been earmarked for private sector. So this is a very, very major boost. And moreover, the government has also proposed setting up of a nodal umbrella body for testing and certification requirement. So these all are going to bode well for the strategic electronic sector. Drones we saw earlier in the agriculture sector. There also it has been discussed. Here again, Drone Shakti has been announced. It's the new initiative which will help commercialize the use of drones in different industries and will basically help establish drone as a service. Last year we saw that drone rules 2021 were announced, which provided some liberal rules for the use of drones, and this Drone Shakti initiative basically builds upon that and further paves way for drones as a service. Telecom equipment, a PLI scheme towards design-led manufacturing of 5G equipment have been announced by the Honorable FM. Overall electronic sector, there has been a positive impact. Coming to sports goods and toys, it has been a mixed bag for this sector. Exemption on import of specific sports good machinery has been removed. As many of the players in this sector are MSME, this move may hamper investments in the sector. Also, a basic custom duty on parts of toys has been increased from 15% to 25%. This also may hurt competitiveness. On the positive side, there have been some exemptions removed for sports goods also, especially those under 9506. Why we are highlighting 9506 is because this is one area where there's substantial global import, but India is currently not supplying to this, catering to that market to a great extent. Now, exemption of these the custom duties on sports goods under HS 9506 will promote domestic capacity building in this space, which will which will help companies also gain export competitiveness, such economies of scale, and they'll be in a better position to access the international market. In fact, Exim Bank had also conducted a study recently on sports good, where we had recommended removing some of the exemptions on import of sports good, and especially with respect to China, from where we are getting a lot of cheap imports in this sector. So we are really glad to see this measure come up in the budget. Also, there has been a hike in the sports budget, which will of course boost the domestic demand for sports goods, and again lead to greater demand, domestic demand, which can be catered by the domestic players. It will lead to greater capacity building, and as a result, it will help improve the export competitiveness of domestic industries. Now, for the next section, I will invite Neha to please take this forward.
Thank you, Janvi. Now we will look at some of the other key announcements and its impact on exports and select sectors. Starting with the infrastructure, PM Gati Shakti program is one of the four main priorities, as Janvi explained. This program was approved in October 2021, and it is a transformative approach for economic growth and sustainable development, and to provide multimodal connectivity to various economic zones and integrate infrastructure holistically. Some of the key announcements under PM Gati Shakti include Vande Bharat trains, new generation trains, 400 of them, and another one station, one product, as Janvi already explained, is also announced. Apart from that, around 25,000 kilometers of expansion in national highway and around 100 cargo terminals, and for multimodal movement of goods and people. The budget has also announced a unified logistics interface platform. This is with an aim to reduce logistic cost and time. Besides these, there is also an announcement for multimodal logistics park at 4 different locations on PPP mode. We are still awaiting much more details on this aspect. And multimodal connectivity between mass urban transport and railways. These are some of the main overall themes of PM Gati Shakti. Next slide, please. Next slide, please. So, in addition to these projects, some other projects in the spirit of PM Gati Shakti have also been announced. This includes the river linking project that Janvi has already talked about. Apart from that, eight new ropeway projects have been announced under Parvat Mala project. This is for hilly regions, and this will not only improve connectivity but also enhance or promote tourism. So this is likely to be on PPP mode. And apart from this, Honorable FM also announced this Prime Minister's Development Initiative for the Northeastern region. This is basically to fund infrastructure and social development project in the Northeast region. Um, Besides these, we also saw green bonds being announced, basically for the purpose of mobilizing resources. Sovereign green bonds will be issued. This will facilitate credit availability to clean energy projects as well as digital infrastructure projects. Um, Besides this, the budget has also proposed inclusion of data centers and energy storage systems to be given the infrastructure status. Once this happens, credit mobility, credit resource mobilizing will be easier for infrastructure projects in these sectors also. So, apart from that, the one interesting point that has come is capacity building for infrastructure projects. So this is a new initiative in the sense that this focuses on skill upgradation of government agencies like central ministries and state agencies and infrastructure agencies. So this will give them a better clarity in planning, designing, and finance and implementation of Gati Shakti projects. So, because the scale of Gati Shakti project is huge, and the Honorable FM also announced that the projects under the National Infrastructure Pipeline (NIP) will also be aligned with the Gati Shakti project. So, since the scale of the PM Gati Shakti as a whole is huge, it underscores the need for capacity building of government agencies. Next slide. Yeah. Besides these, there have been a few more announcements in infrastructure, basically related to housing, like PM Awas Yojana, and apart from that, aspirational blocks program, which was already it has been implemented in around 112 districts. Apart from this, there is a new scheme called Vibrant Villages program, which is being introduced to improve village infrastructure in border villages of northern India. From industry point of view, these three programs and the ones that we discussed earlier will all boost domestic construction sector, EPC and construction sector, and then allied sectors like cement, metal products will also positively impact because of the boost in demand for these products. Like Janvi also mentioned, India has made substantial progress in trade-related logistics, but some challenges persist. So, an efficient and competitive and resilient logistics will is likely to be built through the PM Gati Shakti program, which will be pivotal for boosting exports. So this will also improve economic growth and attract foreign investments and create multiple employment opportunities. So Gati Shakti, instead of just viewing it as an infrastructure program, it has multiple benefits that also need to be viewed. And boosting exports is one pivotal thing that this program will achieve. Okay, next slide, please. Now we come to gems and jewelry sector. Now in this, we see a reduction in customs duty in several products like cut and polished diamonds and gemstones, simply sewn natural diamonds, which has become nil. What I want to mention here is that gems and jewelry export during April to December 2021 grew by a substantial 71% year on year. And one of the key reasons behind the growth in the current financial year has been not only the revival in demand from major export markets, but also the measures taken by the government to support the sector. This has been a particularly important sector from the point of view of exports. And government, as you may recall, in last year's budget, the government reduced custom duty on gold and silver and gold door bars, silver door bars, among other things. These measures, along with the efforts for resolution of procedural issues and to ease ease of doing business, and these were among the key drivers for exports in the current financial year. So on similar lines, if we look at these custom duty reduction in cut and polished diamond, gemstones, and simply sewn natural diamonds, these are steps on a similar note, which could improve exports of jewelry in the forthcoming year. Apart from these, there's a announcement for surety bonds as a substitute for bank guarantee. As the FM herself mentioned in the budget speech, this is also likely to be beneficial for gold imports, as it may reduce the indirect costs associated. Apart from that, simplification of regulatory framework for e-commerce e-commerce of jewelry is also likely to enhance export from this particular sector. We move to the next slide, please. So in the energy sector, the budget has clearly highlighted that clean energy is a major priority for this government. We noted earlier that the inclusion of clean energy technology into the harmonized list of infrastructure and the push from central government to finance availability and investor participation, towards clean energy. So these are welcome step already in the right direction for the energy sector. But this year we also saw an additional PLI allocation to the solar sector, and also the raising of tariff on photovoltaic cells from 20% to 40%. These are steps that are likely to support domestic manufacturing. Though export capabilities in solar space is currently limited for Indian players, the successful implementation of this PLI scheme could substantially increase their domestic capability and create future global champions. Although the awarding mechanism of the enhanced outlay is something that we need to monitor, Mm, besides solar, there have been steps for coal gasification, which will also help reduce carbon emissions. Like I said, the focus here has been on clean energy. There are estimates that say that nearly 3 crore ton of emission can potentially be replaced each year by coal gasification. So this is another step towards clean energy only. And from the point of view of oil, the budget has indicated that blending of fuel is a key priority. Like Janvi also talked about it. I'm just going to give you another perspective that blending of alternative fuels is also a way of reducing emissions, and another rationale behind this step is also to reduce our dependence on petroleum. So what has happened is, to encourage the efforts for blending, unblended fuel will now attract an additional differential tariff of rupees 2 per liter. So the resultant increase in price of unblended fuel will not only encourage switching over to cheaper blended fuel, but also encourage ethanol blending. And there are several other steps that are going to complement this. For example, in this very budget, we also saw a cut in production tax on certain chemicals like methanol, acetic acid, and heavy feedstock used in petroleum refining. We also saw a raising of production tax of sodium cyanide and adequate capacity exists in the domestic market. Besides these, the basic customs duty has also been introduced on blended ethanol E12 and E15, which are fuel blends of ethanol. So imports of E12 and E15 are sort of being discouraged through the introduction of a BCD at 2.5%. So these steps complement each other in promoting ethanol blending in the country. So in 2021, I'd like to mention that India reduced the GST from 18% to 5% on ethanol meant for blending with gasoline. This is also an attempt to cut excessive dependence on imported crude. So from that point of view, this step will have a positive impact on the energy sector. Next slide. Right. Coming to healthcare, the major announcements were related to improving access to healthcare through digitalization. We see the Ayushman Bharat digital mission, and we also saw the National Telemental Health Program. Apart from these programs, we saw the announcement of a blended financing program for sunrise sectors. It was mentioned that among the sunrise sectors, pharmaceutical will also be given a thrust. So basically, as we all know, Indian pharma sector ranks third in the world in terms of production volumes. And the announcement of blended financing will complement the existing PLI schemes, which will not only boost domestic production, but also positively impact exports in the medium term. Apart from this, we also saw a duty hike on certain medical devices, like X-ray machines. This will also complement the existing PLI scheme for medical devices that has already been rolled out. So overall, from the point of view of medical devices and pharmaceuticals, the impact on exports seems positive. But in general, for a healthcare sector, we did not see that great an impact from this budget. Next slide. Next slide, please. MSMEs, it's interesting because MSMEs contribute nearly 33% of India's GVA, and this is 33% I'm talking about in 2019-20. And at that time, MSMEs exports as a contribution to India's overall exports were somewhere around 40%. But with the new revised definition in July 2020, their contribution to both GVA and exports have increased, although we don't have the numbers yet. This year's budget focused largely on improving the ease of doing business and on credit facilitation and skilling of MSMEs. Primarily, this was done by the interlinking of MSME portals like Udyam, eShram, NCS, Asim portals, etc. These 4 portals were interlinked. And apart from this, the RAMP program has also been. RAMP is raising and accelerating MSME performance. This program has also been launched with an outlay of 6,000 crore. This is also likely to help MSMEs become more resilient and competitive. Further, ramping up of the credit guarantee trust for micro and small enterprises, as Janvi mentioned, will enable banks and NBFCs to increase their fundings to MSMEs. So that MSMEs that have already been impacted by multiple waves of COVID will get a relief from the revamp of this scheme. Besides this, basic customs duty hike on certain niche sectors have also been undertaken in the budget, have also been proposed in the budget. For example, umbrella and parts of umbrella, the imports of these have now been subjected to duty of around 20%, which will now be beneficial for MSME manufacturers in this niche segment. Next slide. Yeah, capital goods. Primarily, we saw a major phasing out of duty concession on imports, which was mainly aimed to promote domestic procurement of capital goods in sectors like dairy, textiles, fertilizers, power, and project goods. Given that capital goods account for nearly 10% of India's merchandise imports, and segments like dairy itself accounts for about 1/3 of these capital goods imports, the step to reduce import dependence is certainly welcome. And also the fact that capital goods demand is going to grow in the near future with the continuous focus on boosting domestic manufacturing, as well as higher allocation of capital outlay for infrastructure projects. And these will definitely increase the demand for capital equipment, and particularly with infrastructure projects, construction machineries will become very important. Their demand will rise. Having said that, considering the quantum of import dependence that we have in this particular segment, in this sector, a BCD hike, particularly in import intensive segments like dairy machinery, textile machinery, they would need to be supplemented by some other kind of support for boosting their domestic production. The very reason the quantum of import dependence is so high is that we lack domestic production capability. So while BCD hike is a step in the right direction, I would like to mention that it is not complete on its own and needs to be complemented or supplemented with another policy thrust like a PLI, for example. So from that point of view, although this is a positive step and it has a positive impact on the sector, there is something that needs to be substantiated to make this move more effective. Next slide. So now we come to some other sectors, and there are not many. So we can quickly move to the Q&A session after this. One is hospitality. So this is one contact intensive service that has been adversely affected by COVID, and it is yet to recover because of the start-stop nature of the pandemic wave. One of the top contributors to India's foreign exchange and employment has been the hospitality industry, but it is still under stress because of the pandemic and the restrictions. So to that end, the additional 50,000 crore allocation for the sector is a welcome move, and as it will provide adequate credit backed by the government. This extension in the scheme itself, in the ECLGS scheme itself, will also ensure sustained capital support to the sector. MSMEs in the sector would be able to meet their operational liabilities and restart their business. However, the industry's return to normalcy is still uncertain, although the efforts of the budget are to bring it back on track. Then we come to automotive. We saw a lot of impetus again being provided to EVs this year. Since batteries account for about 40% of the cost of electric vehicles, standardizing battery swapping infrastructure will not only bring economies of scale, but also speed up EV adoption. EV adoption currently is around 1% of the entire automobile segment. So battery swapping will also reduce the waiting time for charging and enable higher asset utilization and operators profitability. This could also stimulate a new business model for the EV manufacturers, where vehicles can be sold without fixed batteries and batteries can be availed on pay-per basis. So this could in turn reduce acquisition cost for buyers and promote EV adoption. So perhaps the rationale behind bringing forth a battery swapping policy is to address these constraints. But besides that, apart from the battery and EV space, if we look at automotive as a sector as a whole, in general, the sector did not receive any particular relief, especially considering that major auto players, major car manufacturers in particular, um, uh, have been facing issues due to semiconductor shortage in the current financial year, also from last February itself. So considering that, and in fact, major car manufacturers have also posted losses in the current financial year quarterly reviews. So considering that situation, automotive as a whole did not receive enough support from the budget this year. Moving on to leather, in the previous budget, we witnessed that there was a withdrawal of duty exemption on import of leather goods, which was to give a push to domestic leather producers, particularly MSMEs. Now, this year we see that exports of raw hides and skins are being supported through a duty reduction, export duty reduction from 40% to 30%. So this is also a positive move for exporters of raw hides and skin, especially of buffaloes. And in the AVGC sector, there is a proposal to set up a promotion task force. This is basically to build domestic capabilities which could serve not only the domestic market but also the global demand. Uh, Further details are awaited on this particular sector. Now we come to metals. We see a mixed impact. On one hand, MSMEs in the secondary steel segments they are likely to be benefited from the extension of duty exemptions on scraps. But on the other hand, revoking they can also benefit from revoking ADD and CVD. Sorry, they could also be that revoking ADD and CDD can also be detrimental to the metal sector. So on one hand, you have MSMEs that are being benefited from duty exemption, but on the other hand, you have major players that can be affected by revoking ADD and countervailing duties, particularly from China. Because we have a lot of import dependence in the sector from China, and but we also have major players in the steel sector that may get adversely affected by this move. Besides these, the thrust on infrastructure projects from Gati Shakti, as I also mentioned earlier, they could positively impact the metal sector because these are products that are used in infrastructure projects. Lastly, I come to apparel and footwear. Now, textile and apparel contribute about 2% of the GDP and around 11 to 12% of exports from the country. This industry witnessed a rebound after the adverse impact of pandemic, basically because of strong exports and also domestic demand during the festive season. So the government has already announced various schemes previously, like the PLI and the Mitra scheme for textile parks. So in this year's budget, it has been limited to duty exemptions on certain items like embellishments, fasteners, buttons, zippers, which are used in apparel, as well as specific leather products which are used in footwear and leather garments. The motive itself is to incentivize exports of handicrafts and textiles and leather garments and footwear. So from that point of view, this does seem to benefit exports to some extent. So with this, we come to the end of the presentation. Now Janvi and I will respond to questions posted by participants.
Thank you, Neha. I urge everyone to please send their questions. We do have some questions, but I urge everyone, if they have any questions or comments, they can please send through the questions tab. We'll take the questions which we have here right now. We have a question. ये किसानों की आय दोगुनी करने की बात पिछले कुछ बरसों से कही जा रही है. सरकार ने किसानों की आय कितनी मानी है जिसे डबल करना है, और जो भी आय मानी है उसके निर्धारण का तरीका क्या है? तो जो किसानों की आय है उसका बेसिस 2015-16 का फार्मर इनकम था, विच इज अराउंड 8,000. एंड इफ वी सी अभी जो फार्मर इनकम है, फार्मर हाउस होल्ड इनकम, वो करीब एवरेज मंथली 10,000 के लगभग है. हमारे एक प्रकाशन है एग्री एक्सपोर्ट एडवांटेज, जो हिंदी इंग्लिश 12 लैंग्वेजेस में आती है. उसमें इस बारी जो कवर आर्टिकल है वो नेशनल फार्मर्स डे के ऊपर ही है. मैं सबसे अनुरोध करूंगी कि वो उस आर्टिकल को देख सकते हैं. उसमें इसके बारे में जिक्र की हुई है अबाउट डबलिंग द फार्मर्स इनकम. The next question we have, it's a very interesting question. The question is, since Fed is increasing interest rates, which shall make investment costly, and affect the private investment and government capex programs and its borrowings. RAG's view on the above issue and GOI's ability to sustain budget outlays, considering that the fiscal base has not grown substantially. Okay, so fiscal deficit is generally considered as bad for the economy. Usually, the focus typically has been that you focus on monetary policy, you do not focus on fiscal deficit. That has been the monetarist theory that we have been hearing for quite some time, and we have seen the failure of such policies in countries such as Greece, where fiscal austerity measures led to adverse outcomes. So a lot of things determine whether a fiscal deficit is sustainable or not. Fiscal deficit, why is it bad? Because firstly, it might lead to inflation. Fiscal deficit as it is not bad. But if your real economy is not strong enough to absorb the infusion which the government is doing, it might lead to an increase in money supply in the market, which might lead to inflation. But as we saw that Indian economy has the potential, our consumptions have not revived, our industrial investments have not revived. So that is why this boost which the government is giving, this will not really feed into the inflation. Although inflation is rising, but the reasons are different. And this fiscal deficit, it will be absorbed by the economy because we have the real capacity to absorb the economy, to absorb it in the economy. The second argument which is given, which I think is what this question refers to, is that there's this traditional notion that if the government is raising money, if government is borrowing, if government borrowing is increasing, then there's this very popular phrase that we say that it will crowd out private investment. Now, this is a very gold standard time theory, which is being, increasingly being seen by economists as not actually true in real life. I would suggest the readers, the attendees to go through something which is called the modern monetary theory, which emphasizes that, the crowding out private investment theory is really not relevant anymore, because the government is in a way the issuer of the currency. Although the central bank manages the currency, but it is the government which issues the currency. I'll not go into the theory, but the private investment crowding out theory really does not work in the current era. Interest rates increasing, the Fed interest rates increasing, that will have an impact on India. There is no doubt about this. We are going to have another cycle of interest rates hike probably, because we cannot sustain the interest rate differential, which might lead to foreign portfolio investments going out of the economy. And with the current account deficit that we have, we cannot really afford the foreign portfolio investments moving out of the economy. So Fed interest rates, that are going to have an impact. But if anything, it makes the case for having a fiscal deficit, higher fiscal deficit, and a bigger boost from the government, so that the where monetary policy perhaps pitch in, there the fiscal policy can pitch in. So if there are any more questions, we'll just wait for 1 or 2 seconds. What is the difference between GVA and GDP? It's the taxes and subsidies that you adjust between the GVA and the GDP. Minus taxes plus subsidies. Will the difference in Manrega not increase rural distress, as immediate job creation will not happen? So yeah, Manrega not increasing is of course a concern. See, Manrega is more of a short-term measure. If you want in the short term to increase the income in the rural area, of course you resort to Manrega and such measures. But the focus of the government was more on the long term this time. And all said and done, we have a limited fiscal capacity, and the government has to make certain choices. So, Manrega is sort of a stabilizer. Okay, every economy goes through booms and bursts and expansion and contraction. The benefit of Manrega is when there is a contraction phase, these fiscal fiscal stabilizers automatically set in and the incomes are protected. So that is the idea behind Manrega. Now, if we see unemployment rates, although they are still high, they have reduced, So these fiscal stabilizers, they can be, of course, I'm not saying removed, but they can be set aside and we can focus more on the long-term measures. So I think that answers your question. Is there any capital infusion proposal for new FI like NAVFIT to meet the growing need of infrastructure financing and Exim Bank in the budget? So it is clear that there is no capital infusion. Yeah, so PSVs have not got recapitalization, although there are budget estimates for Exim Bank. NAVFIT, there are no budget estimate as of now. Because it was, just the capital infusion had just happened. So there are no budget estimates for NAVFIT, but Exim Bank, definitely there is budgeted estimate for capital infusion this year. What would be the support for finding export markets for small farmers? I'll talk in context of the budget, of course, because if I expand the horizon, there is no end to the things. The government has started talking about, how railways can play an important role here. It is talking about how railway can integrate the farmers and MSCs, how it can provide efficient logistics for them. So, and also the one station, one product concept, which is basically aimed at small farmers and MSCs who can actually, come together, form clusters and use this efficient modes of transport to reach the export market. So this is from the point of view of logistics. Of course, there are several other elements like financing aspect. But financing of agriculture sector has been good enough based on the private sector lending norms which we have. The financing has been adequate, but of course, export market, export financing, if we talk about that, of course, first there has to be enough export for it to be financed. That is also another thing. So there are a lot of issues when we talk about small farmers. The government cannot do everything at once, but they have taken significant steps in this budget. Thank you for joining us. We look forward to your suggestions, your comments on the budget, also topics on which you would like future masterclasses. You can email them to us at ccg@eximbankindia.in. Thank you. We will now end this broadcast.